Yeah, good. I'm recording. All right. Well, thanks for joining tonight. So I'm just going to kind of talk stream of consciousness. I guess I will have to mute here. So there's two ways you can send me a chat too. If you want to, you can enter a message. Like if I say hi everyone here, you could send me a chat that way. If you have a question, and hopefully I'll see it. I'm going to go ahead and mute some people here. Hey John, how you doing? Thanks for chatting. And yeah, if you have one, you know what, it pops up a little bit at me, so I may see it. So I'm gonna mute everybody here. I think you might be able to unmute yourselves if yeah, it looks like I might be able to. Or Joe, yours might be just always hot. I don't know why yours keeps going, but you should be okay. So if you have a question, just type it in the chat line there too, and I'll unmute you at times too. So what I thought I'd do is, I kind of said I would start here. I just thought I'd start about, Joe asked if he had any money left, and we do. The market's pretty flat. I'll kind of really talk about just right now, of course, the market, this is as of yesterday's close of business. And, you know, the S&P is pretty flat on the year. It's up 0.3%. So it kind of was zorching forward. And then, hey, Bill, hi, Sandy. And then the market's kind of come all the way back down, of course, to where we are now. And it's relatively flat. That's U.S. stocks. You can see here, international stocks are down pretty significantly this year, down 11% after a large run up into last year. Bonds are not doing well either this year. Bonds, you can see, are down about 2% on the year. Now we're doing a lot better than all of our indices here across the board. In that our U.S. stocks, we are up 1%. Yeah, so like right here, let's see, we're up about 1% this year. After today, a little bit more. Our international stocks are down 10%, but not quite as much as the market. Our bonds are doing much better. Our bonds are up 2.25%, and that's again with the bond market down. So overall, we're down about 1% this year after today's move. Joe, I don't know why your mic keeps going hot on me. I don't know if you can mute it because there seems to be even when I try to mute you, it comes undone. So I don't know if there's something. Yeah, there you go. Now I got you. Maybe I got you. No, it keeps going out. I'm not sure. But anyway, I can't seem to unmute you, Joe. So you're going to be hot the whole time. So it's weird. Weird mic there. But anyway, we're relatively flat on the year, and of course it's been a very volatile year, and everybody's concerned. And it's not unusual. This is normal for the stock market. It's, you know, we have these types of instances. One of the slides that I had sent out to you during the last client presentation was, let me pull it up here. Yeah, this one here. So what it shows is that these are 10% corrections, and anytime you've had a 10% move, this is annotated right here, but it's green line, and I'm highlighting in red. These dots are showing that that's the largest price decline during any one year, and you can see that there's certainly been a lot of down 10% moves in a lot of years over the last 60, 70 years, and it's not unusual to have an up year when the market is still lower. You can see here, we've had plenty of 10% corrections here, 2016. 2014, 2011, and still have the market finish higher. Of course, trying to time this is impossible. You can't time the market and try to guess when it's going to recover. There have been plenty of times also, the financial crisis most recently, where we had this 40% plus correction where the market finished down quite significantly in 2008. But in 2009, rallied back pretty strongly, even though it had a serious correction still in 2009. My point is that you don't know what the market's going to do. There's plenty of knuckleheads who will come on television and tell you what they think the stock market's going to do day to day. And CNBC, as I'm writing in my book, which I'll be getting copies out to all of you soon, and my goal is to get done by Christmas. It's done. It's in publishing through editing. Finally, read it for like the fourth time now, and I kind of continually found myself going back and just beating up a lot of the pundits who are continuously on television telling you what they think the market's going to do day to day, especially the technicians, right? And nobody knows what the stock market's going to do day to day. You just have to kind of hang in there and not worry about what it's going to do day to day any more than I worry about my business. I don't wake up in the morning and say, oh, I'm feeling bad today, I'm going to sell the business, and then go, oh, what did I do at noon, and buy it back, and then at the end of the day go, oh, I'm tired again, and then sell it. You have to kind of look long term. I hope I'm going to be 50 I think a few months, and to me, you have to look at this in long term. I hope to do this for the next 4 or 5 decades, God willing, if my brain's still working. So, to me, you want to take a long-term approach in any type of business that you own, and it's the same, absolutely the same with the stock market. You can't really look day to day because you never know what the stock market's going to do. And that's sort of what the next slide sort of shows too, is that over longer rolling periods of return, here's the 15-year return for stocks, averaging somewhere around 10%, a little more than. With lots of volatility for 1 year variations on that green line of returns. So you just don't know what the market's going to do day to day. So we men, and of course it's all men on this line tonight. There's no well, Sandy I guess is on the line too, but women are better investors. I hate to say it to our group of men here, but we men are just wired to go out and want to do something very quickly. We have to go out and fix it quickly, and usually, it's that fight or flight mechanism that's in us. But usually, women tend to not let these things bother them as much and think longer term and understand that investing, this is just part of it. Because, there's been study after study now. Professor Odian started it, a lot of behavioral finance. He talks about it where you can take one study group and put them in a room and don't give them much information, and take another study group and just bombard them with information. And the group that's being bombarded with information, what happens to them naturally is that they trade more. They tend to react to what's going on instead of relaxing and thinking longer term. And so Professor Odian talks that his thesis is that, or now law, I guess, is that trading is hazardous to your wealth. People want to trade. Now, everything on television is geared to sell you, from TD Ameritrade to Schwab to Fidelity, to trade options and get in and out of the market. And all these hedge funds are geared. You hear about people, getting on, they're long this stock and they're short that stock. Hedge funds are doing horrifically this year. Even when the market was going up, they were doing horrible. Now they've chased performance, and they're supposed to hedge. The idea of a hedge fund is to actually hedge, but they're not. So what's happened is that they're not performing very well this year at all, rather than just kind of hanging in the stock market or holding bonds like we're holding for income. To get back to this slide, Doug, I had Procter & Gamble up here, so I thought, all right, let me talk about Procter & Gamble. Let's just pull up an income statement of Procter & Gamble and take a look at like how I'm generally analyzing a company. When I'm not looking at it day to day or what Procter & Gamble is doing this second. I'm looking at what Procter & Gamble is doing over much longer periods of time. And you can see, back in 20, we went back all the way back here to like, let's go to 2005. Procter & Gamble was making $53 billion in revenue, and top line revenue. And then 2006, they were making $64 billion, and then $72 billion. You can see in 2008, $79 billion, and the financial crisis came. and that certainly hurt their earnings. And they kind of clawed their way out and got up to 81 billion, 83 billion, and then kind of hit a little dry patch here. And the good thing is we haven't had consumer staple stocks in our portfolio other than Pepsi in quite some time because they were so overpriced because everybody was reaching for yield. And one of the things I had our intern put in a slide into our presentation, and I said, you know, we love dividends, and I love dividends. It's part of what we are. I'm a value investor in the Warren Buffett style, and but dividends is a really important component. And the third thing I like is global growth. I want to see growth generation. So it's a three-pronged approach. I said, but you know, so many people I saw with retail clients, they were reaching for yield because they didn't know about bonds, right? They don't understand high yield bonds. So what was happening was they were reaching for the highest yielding utilities and consumer staple stocks and issues of that nature. And so I said, hey, come up with a slide for us and kind of show, I'll show you them here. Over the last 5 years, we've been I love MLPs, those are energy MLPs and business development corporations and real estate and consumer staples, especially. This is one of our core positions we've always had in our portfolio. And utilities, but we've had zero exposure to all of these sectors over the last 5 years. And it's a good thing we had because you can see they were way overvalued. MLPs have lost 16% over the last 5 years. Business development only made 28%. Real estate just 43%. XLP are your consumer staple stocks, and we've done 104 over the last 5 years, and our index has done 96. So, you know, and this is one of the, you get that thing you see, oh, you know, Altrius is 4-star rated. The strategy is our all cap US stocks that all of you and I own the same stocks that you do. And it's done very, very nicely without these higher dividend yielding companies because they were too expensive, and it's important not to own something that's too expensive. And right now, these stocks, what happened was they came down significantly, so I was able to buy at Procter & Gamble and the Kimberly-Clarks. And so even when you see our portfolio sector by sector, if I went to the presentation here on our strategy and showed you that you know, we've always had a big, thick portion of our portfolio in this consumer defensive, this dark brown here on the bottom. You can see 25%, 30% during the financial crisis. But then it got very low, right? We only own Pepsi in this sector and here. But just recently, this year, I was able to kind of load up again, where we're pushing up towards 20% of a portfolio in those safer kind of stocks like Procter & Gamble. And if you look at the slide here, and I didn't want to get too much on the weeds, but since I had it up and Doug, you mentioned it, I thought, let me show you, you know, looking at the top line revenue growth, which has slowed, and it was good that we weren't in the company, but now you see that Procter & Gamble is kind of doing a good job of minding their bottom line. Right here, they were spending 26 billion. They cut a lot of their expenses down to 21 billion, 20 billion, down to 18 billion, and that's been able to keep their bottom line very profitable. But most importantly for you, and looking at the group that's on tonight, and a lot of retirees, is except for you and I, Tim, who are a little bit younger in our in Generation X here. You know, for me, I'm reinvesting these dividends, where some of you are taking the income from it. So when Joe was asking, do we have anything left tonight? I said, well, yeah, Procter & Gamble's fine. It's actually Procter & Gamble's having a terrific year. But regardless, even if our portfolio was down 10% this year, if I went all the way back to 2003, you can see back in the day, Procter & Gamble was only paying, at that time, 21 cents each quarter. But then in 2004, they increased their dividend to 25 cents. And then in 2006, 31 cents. 2008, they increased it to 40 cents. And then, of course, in 2012, went up to 56 cents. And you can see a pattern here where Procter & Gamble has always continually increase their dividend. And that's something I look for. I want to see that management is aligning their interest with yours and my interest. And that's to take care of us by paying us cash. We're not going to invest in something like Amazon, right? Some of our clients occasionally will get angry at me and say, oh, Jim, your stocks, if we look back at your stocks over the last decade, they've only made 11% a year, right? So here's our 10-year track record. And that's great versus value investors, but it's been a growth-driven thing, and the S&P's done about 13%. And I always say in a growth market, when the market is just zorching, we're usually going to lag those companies that are just go, 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 go. And in my book, I have lots of examples of companies like GoPro, and you can look at my blog when I talked about McDonald's versus Shake Shack and why you don't want to buy those kind of stocks that just are astronomically valued. And I actually, in the I think it was last quarter, let me pull up last quarter's presentation I sent to you. I think I had it, yeah. So I talked about the FANG stocks and my concern with these FANG stocks. And remember, these FANG stocks are kind of driving the whole, because ETFs and market cap weighted, which are really now most institutions just buy the whole market. And when you buy the whole market, what you're buying is you're buying the largest market capitalization stocks, whether you like it or not. So we're not going to buy these kind of crazy, ridiculously priced stocks that pay you zero dividends. And sometimes clients will get mad and say, Jim, why aren't we buying Tesla? Why aren't we buying, Facebook? And I said, because the growth that we would need to keep up would be just astronomical. Now, it could happen, right? Amazon could, Bill, you asked a good question. What's FANG? So FANG is an acronym which my neighbor here, Jim Cramer, made up. It consists of Facebook, Amazon, Netflix, and Google, which is now named Alphabet. And part of the problem with these FANG stocks is that it became its own self-fulfilling destiny. So this morning during our investment committee meeting, I talked about Sir Isaac Newton. And if you've ever heard of Sir Isaac Newton's experience with the markets, I think you'll find it interesting. Just Google, Google Sir Isaac Newton and the South Sea Company. Now, what Sir Isaac found is he's got a great quote. He says, "I could calculate the motions of heavenly bodies, but not the madness of people." And you're not that old, Bill. Yeah. So he said, hey, I'm really, now some say he's the greatest scientist ever. He could be. I'm a little bit biased in that I'm a fan of Galileo, has the same birthday as me, and I like Da Vinci a lot. Maybe my half Italian heritage, but what he did was he bought into the South China Sea. He actually realized this was a maddening, right? He bought into the South China Sea, which is a great history because, economics is a very new science. It's only, 300 years old, really. It's quite new. And the idea that you and I could be owners in a company together was not an idea that we could build capital together and become owners. And most people always thought that bonds were a better investment than stocks. So they came up with the idea of, again, building a stock company, and it just took off. It was really one of the first bubbles, other than tulips, which was before this. And everybody kind of bought into the South, and it just went up and up and up. And then he got out, and he saw all his friends on the golf course. Probably, I'm sure Isaac Newton was out there golfing. I don't think golf was invented yet, but he was out there doing something that scientists do, and his friends were saying, "Hey, you're missing out on all of this. You're missing out on FANG, right?" And I was telling my analysts and people this morning, I said, everybody's really young. I said, most people, if you've been in the business 5 years or 10 years or 15 years, and if you're 30-something years old, you're only 10 during when Cisco and Microsoft and Intel in 2000 were falling apart. And of course, FANG is just the newest thing, but you can go all the way back to 1720 and see that Sir Isaac Newton lost about $3 million in today's dollars. Because he got back in, and of course it crashed, right? Because people realized that eventually that, hey, we don't want to invest in something that's ridiculously overpriced And Parliament actually got involved, and the South Sea Company tried to fix. They almost put their imprimatur on it and made the situation worse. So governments can't ever fix this thing. But for us, we don't have to participate in the madness, right? We'll just let those people, we'll let Jim Cramer go crazy and yell and scream, and we don't have to participate in that madness. Now, you feel like a fool, by the way. When this is going on, you just feel like, wow, I'm missing the boat. Look, the S&P 500 is only up, X amount, and these stocks, these FANG stocks, are up a great deal. Well, what's happening now, and when you look at how much of a weight that, say, the QQQ, which is the NASDAQ index, is made up of a tremendous amount of these stocks. If I went to, and you can, I'm gonna show this so you guys can look this stuff up too. If you just Googled, if you Google QQQ, which is the NASDAQ, and then you Google Morningstar, a lot of Morningstar stuff is on here for free, and then holdings. When you Google this, you'll see, the Invesco QQQ Trust, which is what everybody on CNBC is continuously talking about. And what you'll notice when you look at this, you're like, holy smoke. Apple makes up 13%, because remember, Apple's a $1 trillion market capitalization company, so it's going to be the largest company in the tech sector. And then Microsoft is 10%. When you add all these, just the first few holdings up, you're like, whoa, that's 23%, 33%. Then you throw Alphabet in there, it's 43. Facebook, 50% of this index is made up of like 5 or 6 stocks. So you have these few stocks controlling the entire market cap and ETFs, and again, all this passive investment that's going on. Now, we own Apple because I think Apple's reasonably priced and pays us a dividend. We've sold Microsoft because Microsoft got, I believe, ahead of itself. You can see it 42 times earnings, and the dividend yield was a lot lower. So we took our gains in Microsoft last year and redeployed them. But we're never going to own Amazon unless Amazon does, just like we were never going to own Cisco and Microsoft and Intel back in 2000 when they were selling at 100 times earnings and paid 0 dividend. We're not going to own it. But now we can own Intel because Intel is reasonably priced at 14 times earnings. We can own these companies that are selling at reasonable multiples now, and they're also paying us a dividend, so they're aligning their interests with our own. So you always want to be wary not to get involved, not to go with the herd, because those who are jumping on the herd are usually falling off the cliff with the herd, and it could be really dangerous. So I put this slide in here to kind of show about, and I wrote this in a chapter of my book, and I'm mad that the book won't be published in time, probably. I mean, I didn't think this bubble was going to burst because there are some bubbles that are really easy to see. Throughout my 20-year career, it was easy for me to call the tech bubble in the 2000s, and we avoided it because I avoided those stocks. It was easy for me to call a real estate bubble, though I got out too early. We got out in 2005. I didn't want to own real estate. It was easy for me to call the commodity bubble. Oil was pushing up past $110, $120. Another neighbor here who's worth hundreds of millions of dollars worked for Goldman Sachs was calling for $200 a barrel of oil. By the way, he did fine, but those who took his advice and said, I'm going to jump on the oil, it didn't do so well. And we got out of our commodity positions in the summer of 08. It's one of those few times it was perfectly timed. Now, I didn't call the financial crisis because to me, those are emotional events. And I didn't call the energy crisis because we had a technological change of sideways fracking. So we kind of suffered through those 2 downturns. But this bubble is easy for me to see also. Now, that doesn't mean that Facebook's not going to go to, Facebook could very well go to a gazillion. It could just keep going up because markets can remain irrational longer than you can remain solvent oftentimes. But now if you look at these companies in the last 3 months, such as, here at Amazon, we'll do the FANG stocks here, Facebook, Netflix, and Google. What you'll see is that these stocks are starting to take a bit of a beating this year. They're all down, as you can see, a lot more than the stock market just in recent days. Now, again, they could reverse and they could keep ripping, but we're not going to participate in that. My job is to get you a prudent rate of return, and I'd rather lose a client who said, Jim, you've only gotten me 11% a year for my stock portion of my portfolio. That's not good enough. You know, to me, because I keep saying I don't want to outperform the S&P 500, because what that means is we're going through a recession or usually a downturn when that happens, and that's what's happened this year. Right now, we're outperforming the S&P because our stocks are doing better than the S&P, which they weren't up until a couple of weeks ago. So I'm going to unmute everybody right now here too, to see if you had any particular questions that you want to yell out at me. It's probably a good spot for me to pause. I may have missed any chats that somebody put in here. Does anybody have any particular questions they want to throw out? Otherwise, I'll keep pushing ahead here for our strategy. Okay, so let me go back to the slide presentation I just put out to you. I'll mute everybody again here if I can. So one of the things, Bill asked why the recent sell-off, which is a good question. Well, it's one I should have addressed right out of the gate. And you know, I always quip, well, the market's selling off because there are more sellers than buyers, right? I mean, there's more people heading to the door, and they're more scared, and it's just that they're getting out, right? They're selling. Short-term nervousness, and why that is? Well, I could give a couple of reasons. I mean, one, you could say, well, the upcoming elections are making people a little nervous. That's possible. Two, and more likely the case is, and I would think is the Federal Reserve. So if you look at the Fed, I put a slide here for the Fed, and the third, by the way, before I forget, is the tariffs and the fear of trade war. If you look at the Fed and recessions, so I put this slide in the last slide deck that I sent you, and what happens generally is the Federal Reserve, they're really bright people, right? They have PhDs in economics, but they're just like you and I. They put our pants on one leg at a time, and they usually push us into a recession. Now, there's times when the Fed purposely pushes us into a recession, like what Paul Volcker did here during the 80s. You all remember when we had 16, 18% CDs and mortgage interest rates. And Volcker did that on purpose because he had to raise interest rates to stifle inflation, which was getting out of control here in the late 70s. That forced us into a recession. You see, this was a pretty long recession that we went through in the early Reagan years, and a lot of people wondered if, Reagan was going to make it during those early years, and if the presidency was even a position that anybody could hold after the Carter years and Nixon debacle. What you see the Fed doing, though, and you'll see a theme here, is that every time the Fed raises interest rates, we go into a recession, the gray lines being recessions. So here's the Fed raising rates, and here's what's going into recession in before 72. And that's because Nixon's guy, Burns, kept the market really low. It led to a huge re-election victory for Nixon. You hear Trump kind of saying, hey, keep rates low, which is good, adds steam to the economy, but the Fed's got to try to keep the economy from overheating too much. And I may get into some of those economic indicators I'm looking at to kind of show you. But the theme here is the Fed is always raising rates, and we usually head into a recession. The Fed tries to keep this as a small recession, right? And the question mark here is, well, are we headed into the next recession? And the answer is, I don't know, or when. If the Fed raises rates too much, too hard, too fast, too long, then yeah, we're definitely going to head into a recession. Then the Fed will go, oh no, we can't do this, and they'll drive, they'll lower rates really quickly, try to stir the economy, keep that recession short-lived. But the Fed does what the market tells it to do. And the Fed sometimes doesn't listen and can raise rates too quickly right now, as I think that they probably are. That's where I think Trump is actually right. I think that they're steaming ahead with low inflation and the economy not doing great, doing okay still. Although Janet Yellen disagrees with me, she was on the former Fed chairman today saying, she's worried about the Fed, and she's worried about the debt levels though too. And if the Fed's raising debt and interest rates, that increases the interest on that debt, makes things worse too. So 3 reasons why we have the sell-off right now. 1, midterm elections, probably the least. 2 is the Fed raising rates. Everybody knows the Fed's going to be raising rates, but there's a fear the Fed raises rates too quickly, and they've changed their language to be a bit more aggressive. And then 3 is the tariffs. Okay. And the last presentation, I kind of talked about that. This is the second quarter. Let me pull that one up. And I basically did it by just putting a big picture of a guy here in tariffs, right, and the trade war potential going on. Now, the good news is we got a new deal with Mexico, we got a new deal with Canada, and as I have meetings with every month, I have meetings with senators in New York, and it's interesting. My friend Senator Young of Indiana is a good friend. Goes back to the Naval Academy and our days in the Marine Corps together. And the Republican senators can't figure out Trump, right? It was kind of like the tax deal where Trump says, "Hey, no, absolutely no higher than 18%, and then definitely no more than 20%," and then he kind of, negotiates and gets to 21%. So he usually comes in with a lot of bluster, and then pulls back and negotiates. The Chinese negotiation is going to go a lot longer, and it's going to be a lot tougher, quite likely. And he, as everybody knows, on both sides of the aisle, that our intellectual property and other issues where China can just debase their currency is able to effectively, cheat on these issues. Now, where I think Trump is wrong is it's not a zero-sum game. If another country is selling more goods, let's say they're selling more Nestle chocolate bars, which we own Nestle, and we're buying more Nestle chocolate bars here in America, that's okay, in my opinion, that we have a trade deficit with Switzerland, and maybe we're not selling them as many jet fighters or something. We can all win in the long run and still do okay with trade. So if he's just negotiating a deal, that's fine. But this is certainly causing some dismay and worries in the market when you see the market sell off when Trump says, "Oh, we're absolutely going to put even more tariffs on China when if the meeting doesn't go well at our next meeting with President Xi." So and it's exacerbated by all these mathematical algorithms where the market could be up 200 points and then it just falls 300 points. And you saw that yesterday. Yesterday was crazy, right? The market was up 300 points. At one point it was down 500 points and then rallied to finish up or down 200 points still. I mean, just insanity, really, from the market going back and forth. So all of this causes a lot of fear, whereas going back to Procter & Gamble, really what we should be thinking of is what impact is this going to have on how much Tide is sold in China over the long term? And if the answer is not much, which it's probably not, as a patriot, some of these issues may bother me, but as a capitalist and as a global investor, I'm not going to change our strategy based upon those issues. The goal for me is to look much longer term and to see that, okay, we've got these 3 things impacting the economy. We probably want to be a little bit more conservative. We're probably on the latter half of this rally. We've been in for quite a long time now. How much more do we have to go? This was another slide that I put in, I think it was first quarter of 2018, where I showed like, hey, this rally has gone on for an extraordinarily long amount of time, but it's been a very shallow, it must have been the end of, 2004, 2017. And what I said at the end of 2017 in the newsletter and in the slide is that, yeah, this has gone on a long time. However, what we're seeing too is that this has been a very shallow recovery. It has not been, a go type of recovery, and because of that, the recovery. Yeah, here it is. This is third quarter of 2017. So here's the average of the last 6 economic expansions, and the current expansion we're in has been a 2% GDP growth expansion. It's just been really, really shallow. And I was so there's we haven't had that snapback and recovery that we normally have. So it's been quite narrow. And this is where I think the Fed's kind of getting ahead of itself. And if we looked at, economic indicators like GDP, and I was showing my staff this slide a month or so ago, I think. I'll pull this one up here. If you look at GDP, and let me do it. I'm going to show you with the recession. It's kind of a cool chart I made on data stream here. I'll take it off mute on everybody here too, while in case you had another question to throw out while I'm bringing up this slide here. And
I hope that's water.
okay, this is it is water, yes. I don't drink very often. I probably should drink more often, right? I drink a couple of glasses of wine a year. That's about it. So here's GDP over the last 60 years, and I grade out the areas that are the recession, and you can see if we kind of did a mean here, American GDP over the last 50, 60 years has been right around 5%. Of course, there's been really high highs and there's been really low lows and along the way. And you can see the recession. Every economic indicator, don't believe anybody on television who says, oh, this economic indicator and this economic indicator and this economic indicator indicate that we're heading into a recession, because it's complete nonsense. I mean, every one of these economic indicators that I look at, I mean, and literally, I don't care which one you pull out here. You can pull out employment benefits, you can pull out jobless rates, productivity, car sales, which is one I really like because that really shows discretionary spending for people. Any of these economic indicators can change in a moment's notice. I mean, that's what's so fascinating about economics, right? How you and I feel. Are we going to go out and hire more people right now? Are we going to invest? Are we going to borrow? All of those questions can change very, very quickly. And when you look at all these economic indicators, I look on a daily basis, whether it's the GDP that we're looking at right now or the Michigan sentiment or personal consumption income one I'll just show you, they're all rearward looking. So it's just showing a point in time. And again, to me, I could look at the PCE index right here in core and say, hey, you know what? We're only at 2%. 2% is pretty darn good. That's right where the target is. Why is the Fed raising rates? Well, they're also looking at other things and saying, yeah, but the economy is starting to heat up a little bit, but it's not heating up the way it's been historically. We've been in this terrible low, muddle along 2% GDP that I've been modeling for. We got some animal spirits back in the market. Trump was elected. Some people got excited that we had tax reform that's incentivized some animal spirits to get out there and spend, but not that much, right? So personal consumption is up a little bit, wages are up a little bit, but inflation's still down because productivity is good. All of these economic indicators can collapse in a moment's notice for any reason. It could be anything. It's usually something you don't see. So don't believe anybody who thinks they can divine, because the Fed always gets it wrong. As I just showed you, the Fed always gets it wrong, and they're always raising us rates right into the next recession. And they can do it too quickly, right? Whether on purpose or not. So when we look at GDP, we're in this muddle along scenario where here we are at 5%. We're still low, right? We're still now, Trump is touting that, okay, GDP is coming up. And this is pretty good. And maybe we're getting back, but we're certainly not overheated. We're just in this type of scenario where it's just like, okay, it's not great. One of my favorite charts that I make and look at regularly is the consumer charts, and you look at if I increase my salaries for my employees, well, they spend more money, right? If we have more money, if we're making more money, and even though the stock market's up, what I see is that clients start taking more money out. That's just natural. So the blue line is disposable income going back to 1960. And you can see blue goes up, and then you hit a recession and blue goes down because companies lay people off and cut salaries. And this happens all the time, right? And here we are, Paul Volcker, I was talking about the interest rates in here. When the CPI was high, he raised interest rates. Well, what the economy did, it went to a recession. People got laid off. Salaries get decline. And that's what we just went through in the most recent financial crisis too. But you'll notice that there's a almost direct correlation between if I pay somebody more with the blue line, the yellow line starts to follow. And that's what the Fed gets a little nervous at right now. They're like, oh, people are getting paid more. Maybe the newer people who don't remember the financial crisis they just went through, maybe they're not saving as much. Maybe this may cause the market to heat up. You know, again, I'm not seeing that. I'm seeing a little bit more cars purchased, a little bit more homes built, but not, you know, we're not like going like gangbusters, right? So I think that the economy is good, but I would give it like a B minus. It's not great. So we can keep doing well, and we can keep making money, and we're not overheating. That said, there are risks out there. So in the strategy I've set, we're not as overweight stocks as we were 5-6 years ago when we were at 60% stock. Right now, we're basically 50-50, you and I. Unless your personal risk tolerance is a little bit heavier, you know, we're at 50% stock, and we're at, right around 48% bonds for our allocation for our clients. This is back in third quarter of 2017, which at that time we were only at 42% bonds and stocks. Now what I've done is we continue to take kind of chips off the table, and we're only at, if I looked at our strategy right now in get to 2018 Q3. Now, as you can see, we've continued to kind of take money off, and we're basically 50-50 stock to bond. And our bonds are, you know, from a yield perspective, we're making about 5.5 to 6% here, and hopefully we'll continue to do that for our bond portfolio. For the yields on our bonds for like Hertz and those companies. Our U.S. stocks are making about 3.8% yield in dividends, and our foreign stocks are making about 4.5% in dividends, the Nestle's and Unilevers of the world. So overall, the whole portfolio is pushing out about 5% a year to you. So Joe, your initial question is, do we have any money left? And my answer is, it doesn't matter what the portfolio value is. I mean, I get paid based upon your portfolio value, right? I get paid based upon the portfolio value. But if you have $1 million in your portfolio with me, it's pushing out $50,000 a year in income. And if we have a horrible return for the year and we lost 20% and you went down to $800,000, I'm losing a lot of money because I get paid based upon your portfolio value here. But you'd still be making $50,000 a year, as long as Procter & Gamble is still paying you that dividend. So to go back to the original slide I erroneously kept up, Doug warned me about when I had it up there, you know, as long as Procter & Gamble doesn't cut their dividend, it doesn't matter what their price is. You can see today their price is $89.19. They could, and if we looked at, I mean, they could go down to $75 today, which everybody would be feeling bad, but they'd still be paying 72 cents a share, a quarter, which is a nice 3% dividend, 3+% dividend. And you can see, even if Procter & Gamble, if we look at all the analysts, all my neighbors here in New York who are out there with their Ivy League degrees trying to guess what Procter & Gamble is going to make this year, and I don't know. You can see the mean estimate on Procter & Gamble is just under $5 a share. Now, some analysts, and you can see they rate these analysts, and one of my neighbors is right around the corner here, where he works for Raymond James in the healthcare sector. And you can see all the different guys like Societe Generale, and some of these guys are named and some of them are hidden. And, you know, you can see their star rating, which means absolutely nothing. This guy's at, you know, 487. This guy's at 511. This guy's at 516. This guy's at 510. They're all over the map, but they're pretty close. These guys all have dinner together. They all think the same way. They all went to the same Ivy League schools. They all think with the same dopey Wall Street mentality. And that's what you find. They all have a consensus. So that when all of a sudden Procter & Gamble slips up and has a bad quarter, let's say that they only make $4. Let's say all of these analysts are wrong and Tide is just not selling, right? I mean, you could go to Yahoo Finance and pull up Procter & Gamble, and you can pretty quickly realize, like, okay, Procter & Gamble, which has had, again, a great year since we bought it, the market's up today and everybody's feeling good. But again, it doesn't really matter what Procter & Gamble's price is, because you could see, you just saw all the analyst estimates of what they think that Procter & Gamble's going to make. Here's their trailing. They make $3.83. Let's say that's all they make. Let's say instead of making $5 like all the analysts think they're going to make, that they only make $3.83. Well, they're only paying out $2.87 in dividends, and we know for the last 20 years they've continued to increase their dividends. So that's all that should matter to you. Unless we're selling Procter & Gamble today and we lock in a loss or we lock in a gain, this is the only thing that matters to you and I, is our cash flow. And for Tim and I, we're just reinvesting, you know, younger clients, we're just reinvesting our dividends and buying more shares. In fact, I want it to go down. I want Procter & Gamble. I'm in the only business when everything's 20% off, nobody wants it. Why would you want Procter & Gamble to go up? I mean, it'll make you feel better, but especially if you're a retiree collecting your 3.25% yield, what do you care what the price is? You're only paying me more if the price of Procter & Gamble goes up, right? Because I get paid based upon the price. And Bill asked, what about lead? What do you mean lead? I lost you on that one. You have to clarify that question about lead. Oh, PBI. Yeah, same thing. So Pitney Bowes, you know, and clients, and I could be the smartest guy on the planet, and I get a kick. I'm 4-star rated with our portfolio, and I always have these, you know, I send out that thing about self-proclaimed legendary portfolio manager. And I say, well, I mean, I've beaten Warren Buffett over the last decade, so I guess I should call myself legendary, right? But my clients will pick up the one stock that they don't like, that I pick the bad stock, you know, and they're always going to pick up the one. But I don't care that Pitney Bowes is down 30% this year or 20%. It's paying you, Bill, 11.5% a year. I know Pitney Bowes is lead, but I want it to be lead. I want it to go down. I don't want it to go bankrupt, obviously, because I don't want to lose our investment. But it's paying you 11.5% yield. Where can you get 11.5% yield to fund your retirement? Living in, you know, Florida and having a second home. You can only do that with the stocks that we own. So why worry about the ups and downs of a particular stock? Now, we're not going to invest too much in companies that are distressed. So I invest in 3 types of companies primarily. One I would call classic value. That's the majority of these are stabler, more stable type companies that everybody hates, right? These are the beaten down companies. Then I would call the other ones persistent earners. And the persistent earners are your Procter & Gamble's, right? They're pretty persistent. People are still going to buy Tide in good markets and bad. And even if things are tight, maybe they don't buy Tide, but they'll buy a little bit cheaper product that Procter & Gamble makes. And the third, and I'll usually have a few sprinkled in, are those companies that are distressed, right? That are changing, they're changing their whole way that they do business, like an IBM or a Pitney Bowes. And we're not going to have too many of these types of companies. And usually we want to get paid to wait, right? So we want to get a big fat dividend to wait for that turnaround to occur. So those are the 3 kind of companies that I'm generally buying for you. And that's Procter & Gamble. That's our strategy, and that's one of the reasons why when I show, you know, on our website, I always show a prospective client who doesn't have the benefit of all of you who've kind of been through ups and downs over the decades you've been clients. When I show a presentation, I always go to one of the last slides, and I always say, listen, if you only remember one slide in my entire presentation, just remember this one. And yeah, we've done really well over the last couple of decades, and we've made a lot of money, and that's great. But there were times when we weren't making money. You know, the financial crisis, the energy crisis, we were losing some money here. But the green dots, the green triangle, our clients never had to go back to work. Our clients never had to change their lifestyle. They just kept collecting their dividends and interest from their portfolio. And if they took 4% a year, they started with $1 million, they have more than $1 million today. They're still doing fine. They never dipped in the principal. Now, if I start taking out 10% a year, then I have to hope that the stock increases in price to get them the income that they need. And for me, what I've been doing with these green triangles, the dividends that come from Procter & Gamble interest, is I'm just reinvesting them. And that's the brown line here that continues to grow, right? When you're able to reinvest those dividends and interest, that can become pretty powerful to total return over time. So that's always been our strategy. It's quite boring. And I had a financial advisor say to me, I was giving a presentation, this was just last week, and he said, why don't more Wall Street guys do this? And I said, you know what, it's just not sexy. They always want to buy whatever's hot. And Wall Street's always happy to bring out the next sexy product. Right now, it's alternatives. I mean, alternatives are the absolute rave. And if you look at all these risk parity strategies, I mean, one of the robo-advisors, Wealthfront, has their Wealthfront that they're putting like 10, 15, 20% of their clients into the Wealthfront Risk Parity Mutual Fund. And if I went to Morningstar and showed you how this thing is doing, I mean, it is a POS. It's just a piece of crud. And it's a piece of crud because it's trying to guess what the market's doing. Now, these are really bright guys. I'm sure that this guy who runs this fund is a lot smarter than me, Jacob Jurek and Celine's son. I'm sure they've got, you know, degrees from MIT and MBAs and PhDs and whatever. But they're trying to guess what this particular, all these risk parity funds, instead of just owning a bond that's paying you 5%, and I keep saying that simplicity is much better than trying to get really sexy and do really dumb things that people continuously do. You'll notice that this fund is down 10% this year. It's just doing terribly. And by the way, the whole category of Morningstar, all the funds, they're averaging it down 6% this year. You know, 6% down year to date. And they're supposed to, they're risk parity, but you know, they don't care. They're just trying to sell something that they think financial advisors will buy, and they think institutions will buy. And it's enraging to me when I see this kind of nonsense going on Wall Street. But it's just one thing to another. They were selling tech stuff and internet stuff during the early 2000s. Then they were selling real estate stuff. Then they were selling commodity stuff. Now they're selling alternatives because they feel like, okay, you know, a classic 60-40 is just boring. You know, why don't more people do this? And I say, I guess because it's not sexy. You know, but I prefer, you know, living to fight another day in the Marine Corps and in finance is vital. And not blowing up your portfolio. In my book, I have a whole chapter on all really smart guys who blew up their hedge funds, who blew up their mutual funds. It doesn't matter which mutual fund you want to pick. Let's talk about like Fairholme Fund. So he was fund manager of the decade, FairX Morningstar. Ken Hebner, same thing, another fund manager of the decade, smartest guys on the planet. They went from managing 18 billion down to managing like nothing. You know, I don't even know why they still manage. Like this is a Fairholme Fund now. You can see it's 1-star rated now. He was fund manager of the decade. He's still managing $1 billion. At one point, he was managing $18 billion. I don't know why he's still managing $1 billion. I'm jealous that he's managing $1 billion because I only managed 370 million. But why? His performance has been so abysmal. And the reason why it's been abysmal is because he wants to get his name on Money Magazine and say he's really smart. He's having another, oh my God, I didn't even know it was this bad. He's down 21% this year. 21% he's down. He's in the bottom 100th percentile the last 1 year, 3 year, 5 years, 10 years. Aren't you glad I don't invest in mutual funds and do what every other financial advisor does, which is chuck you in 25 mutual funds, you know, and put you in the smartest fund? Because in choice, if I'm selling, I got to sell who did great, right? So I'm selling this guy because he's fund manager of the decade. And look at me, I'm so smart. I use the best managers. It's just absolute nonsense. To me, I got to look across the table at you and say, look what I did. And the reason why I did this, people say, well, how did he do this? How did he do this horrible performance? And this is how he does it. Just like I was telling you to avoid those FANG stocks, that they're too overvalued. If you look at his portfolio, it's highly concentrated. So you don't have more than 1.5% in any one stock. He's got 27% of the portfolio, more than a quarter in one stock. Then he's got 8% and another, well, 16% here in Fannie Mae and Freddie Mac. Then he's got Sears, which that's not working out because they went bankrupt. I mean, just horrific. So if we added all this up, 30, 45, 50, 55% of the portfolio is in 4 positions. I mean, that's just stupid on any level. 62% of the portfolio, as you can see here, is in 10 holdings. Well, you and I, we own 75 stocks. You know, if I pulled up our portfolios, let me pull up our portfolios here just so you can see it. If I pulled up our portfolios, what you'd see is we own 75 stocks and we own 100 plus bonds. And we're going to do that because I'm going to make mistakes. You're going to have bankruptcies. We're going to have, if I'm trying to get you that 6 or 7% on the bond side, I know I'm going to lose some bonds. I know we're going to have some Toys R Us issues along the way. We're going to have some Eastman Kodaks. But you can see we own, actually let me do it by income so that you can see the most important part of this, the appraisal with income. Because as I've been saying, you know, that's the one thing I can control for you. I can control the income flow for your portfolio. And here's where, to me, is much more important, right? The portfolio values are going to go up and down. But our portfolio, where I'm not going to buy too much in any one stock because I want to live to fight another day. I think that's very, very important that we not invest too much in any one stock. But you can see right now your U.S. stocks are making you about 4% a year, and your international stocks, I scroll down, which I also own, I'm side by side with you, is 4.5%. So we're getting more from international, which leads me to the last part. And then our bonds, we are at, all of our corporate bonds, 6%. So that yields an entire portfolio that's pushing out about 5% a year, regardless of the ups and downs. We could be down 10% right now. As long as we don't have defaults, as long as Procter & Gamble doesn't cut their dividend, who cares? Don't worry about the downsides of the market. Now, one of the reasons why I like, and this is in the last thing that I sent you, the communique. Let me get to the this quarter's client presentation that I sent a week or so ago. What you'll notice is in the strategy section here toward the end, that international stocks are cheap relative to U.S. And these things tend to go in cycles, right? I mean, last year we did much better in international, but it was a one-year type of anomaly. If we go all the way back to the 70s, international stocks well outperformed U.S. So the green shading below the line is international stocks outperforming U.S. stocks. And then in the early Reagan years here, U.S. stocks started to do better. In the later Reagan years and Bush years, international stocks outperformed. And then we had the tech bubble here, start the Clinton years, where U.S. stocks well outperformed international. And then starting here, the latter half of Obama, international stocks did well. And then we've had this long period of time here where U.S. Now, question mark is, where are we going to go from here? Well, I showed you how we're 50-50 stock to bond right now. We're also basically 50-50 between stock. We're like 26, 27% U.S. stocks, and 23, 24% international stocks, somewhere around there. And I don't know, right? But so we're diversifying. But I think that not only are you getting a higher dividend yield, but international stocks are really cheap and compelling from a standpoint of valuation right now. Any metric you use, whether it's price to sales, price to book. If you look at our disciplines, you and I are invested in our global income. Well, our global income is our balanced portfolio, which consists of our U.S. stocks, this strategy, our bonds, this strategy, and our international stocks, this strategy. Now, if we look at the fact sheets, drill down to our U.S. stocks, what you'd see is that, if I grab the fact sheet here, is that our PE ratio is just one metric, is at 12.3, right? I'll make it a little bigger here so you can see better. And again, that's much cheaper than even our index and much cheaper than the overall market at 20 plus times earnings, which is, again, is driven mostly by those FANG stocks right now. If you actually strip out the FANG stocks from the S&P 500, it's only selling at about 13, 14 times forward earnings. So it's relatively not overpriced. But our U.S. stocks are selling at 12 times earnings. And if I pulled up our fact sheet for our international stocks, what you'd see is, a little bigger, selling at right about the same, PE 12 times. Now, international is a lot more beaten down. So I think, if I was a guessing man, I would say I think that international is going to outperform U.S. over the next 5 years. Now, I'm not willing to do what some of these other portfolio managers have done and just go all in international. We're going to keep a balance. Living to fight another day is very, very important. And keeping your portfolio, my portfolio balanced is vital to our long-term success. So the same is said about value versus growth. This has been a tremendous, I mean, you go back rolling decades, values always outperform growth. But usually it doesn't happen except when recessions come. Well, we haven't had a recession since the financial crisis. So what's happened? Growth stocks have way outperformed value. Now look at the last time this has happened that's been this low. Remember what happened here? This was the internet bubble. Those stocks I was telling you we couldn't own back then, Microsoft and Intel and Cisco, which was selling at 100 times earnings and didn't pay a dividend. And I wound up buying for you in this period of time here. Well, what happened, of course, is this imploded and value had a tremendous period of outperformance. Question mark here. Is our strategy as value investors going to outperform growth over the next 8 years? Now, I've still made you 11% a year from our stocks, which is not too shabby. And this could reverse very quickly. That 2%, that 13% a year, the 2% differential on the S&P versus me could get wiped out very quickly when the FANG stocks and those high-tech stocks just implode. So for a decade, a part of being a value investor is you can look like an idiot for years. And you just have to be willing to just say, I'm an idiot. But I'm not going to do what Sir Isaac Newton did. I'm not going to buy the South Sea Company and pay some astronomical valuation, especially if it doesn't pay you, my clients, a dividend, that we can't reinvest our dividends or provide you an income. If you fire me after 11% returns from the U.S., I'm going to say, I just didn't do a good enough job of explaining what it is that we do. And oftentimes what happens is, to go back to that FANG stock from last quarter, is that you just have an implosion. It just has happened for every other bubble. So avoiding bubbles, really important. Avoiding stock collapses, that's natural. That's going to happen. Stock market's going to collapse. Stock market's going to go through its natural ups and downs and progressions and 10% corrections, just like the one slide I showed you earlier that, is just part of investing. Is hanging in there and not panicking. With these 10% corrections like we just went through, we're going to add another one right here for 2018 where we had this. It might go lower, right? It might be a 15% correction. And will we finish the year higher or lower? I don't know. I don't know what this line is going to look like. But the key is, don't sell. It's just a paper loss unless you lock it in. And I've seen so many people where they sell. So many people really during this financial crisis locked in their losses and they're still sitting in cash wondering what to do. And it's really sad. I got to sit down with a prospective client tomorrow. Sold his business for $8 million. He only had $6 million left. Don't ask me how that happened. I guess I'll find out tomorrow if he tells me. But how did he lose $2 million in a matter of 6 months? Well, he bought something really sexy. He bought Bitcoin or something. He didn't read my warning when Bitcoin was at $20,000 or $20,000 earlier this year. That bubble just, burst. So these things are common. Don't worry about it. You know, I used to say when we were flying airplanes, for fighter pilots, you know, you do one emergency procedure, you hope that corrects it. If it doesn't work, you do another emergency procedure, you hope that works. If not, then you punch out. Well, C-130s, we didn't have the advantage of being able to punch out of our airplane. We had to sit on our hands. So we always used to say that the first emergency procedure for us was sitting on our hands. Don't do anything stupid. Think. And it's the same thing with investing. You don't want to do something stupid. You don't want to just react. Charlie Munger, Warren Buffett's partner, calls it "sit on your ass investing," and I put that quote in my book because it's just too funny, right? Just sit on your ass investing. Just turn off CNBC, turn off the noise, tune it out, hold Procter and Gamble, collect your dividend, and don't worry about it. Is really the key. So I've talked more than an hour because I just start rambling on here. I'm going to open it up to everybody again here, unmute everybody, and see if they have any questions. I was going to cover bonds, but fortunately, I probably don't have time to go into bonds here too without completely boring everybody. So I'll throw it out to any other questions that you may have. Wrapping it up. Anything else on your mind?
Jim, I don't necessarily have a comment or question, but rather a comment. I've dealt with 3 wealth management companies in my last 25 years, and I appreciate your willingness to be somewhat transparent and to open yourself up on a regular basis for these kinds of exchanges of information and questions. And from the Stiegelmeyer family, that's why we do business with you, because you are that transparent and that open. So thank you for your time.
No, thank you, Doug. Call anytime. That's the one thing I always say is it's a little bit different in that if you email me at 11 o'clock on a Friday night, I'm usually sitting right here in my home office and you'll get an email back. So it's
as you know, I have and you have. So thank you.
I mean, I'm down to about 80 hours a week for work. This year is probably a little bit more because of Annie would tell you it was 100 hours this year because of writing the book. But yeah, it's a labor of love. This is what I do. So I don't have any other hobbies. Annie won't let me have any girlfriends, so I don't have time for anything else. I just have to
mind your P's and Q's.
Exactly. Yeah.
Thank you again.
Thanks, Doug. Anything keep you up at night? Yeah, Bill asked anything keep you up at night. Yeah, everything keeps me up at night. I do need 6 hours of sleep now. I can't like I used to when I was younger. I could work with less sleep, but I'm always worried about what I could be missing, and it's usually something that you don't see coming that usually hits. For me, I think the biggest worry that I worry about is nuclear war. The good news is those things are generally unstable. So I think we're a decade plus away from a rogue nation or a rogue unit getting hold of a nuclear weapon, which could be really detrimental, obviously, to capitalism and the economy. Although the world has gone on, obviously, with from our nuclear attacks and World War II. But the day-to-day market volatility worries me only in the sense that I feel it's the reason why I do this tonight, right? Is when I could feel clients getting nervous or more calls coming in. Most of our clients who've been with us a long time, they kind of hang in there. They realize that this is part and parcel of investing, but it's still unnerving, especially when you're in retirement, to see your portfolio go from 3 million down to to even to 2.8, and because people start locking in numbers, right? It's that loss aversion that everyone has, especially since we're only a decade out of the financial crisis. So it's very unnerving to a lot of people, as it is for me too. Because, I have payroll to make, and I have overhead and employees to pay for, and when I get paid based upon your portfolio value. So when the portfolio value is falling, that my profits are hurting, and if you fire me, I lose my income. So that's my worry, and that I'm missing something. But that's also why I choose the more boring way to invest, in that your income is not going to change as long as, as long as Procter and Gamble here, as long as their income and their dividend payment remains steady for you, then your retirement is not going to change, regardless, irrespective of the market volatility or the price changes in Procter and Gamble. They're just going to keep paying you out that dividend. Same thing, by the way, on I wasn't going to talk too much about, but we could talk about like a local company here like Avis, which is right here in Parsippany, New Jersey. I'm always worried, what am I missing? Which bond is going to go bankrupt on me? And I've met with 28 management teams this year, CEOs and CFOs, including Avis. And I worry, like, okay, what if they were making $5 billion in 2009 and they've increased? They obviously went down after they were making $6 billion here in 2008, and then people stopped renting cars, right, after the financial crisis. And now they built themselves all the way up to almost $9 billion again in revenue, and they did a good job of, cutting their expenses, their bottom line, and you can see their operating income's been good, and they have plenty to pay you and I back. They're paying $211 million in interest payments to us. But my fear is, what if Avis goes bankrupt? And that's why we don't have more than 0.5% in Avis or Hertz or any of the bonds that we own. We want to make sure that we're diversified. And, what if we have autonomous driving vehicles? Will nobody rent cars anymore? Well, I think about it and say, well, when I come down to the Carolinas, I fly from New York to Raleigh, but now I got to drive out to Charlotte or drive out like I did this summer and drive back to Raleigh and drive to our New Bern office. And under that scenario, I'm gonna rent a car. Now, if I'm Doug and I'm coming up for the U.S. Open, I'm probably just gonna fly into New York and take a cab, right? And I'm not gonna rent a car for that trip, and that's okay. So, and Avis knows that. Avis knows that's not where they're gonna get a rental. But if I have to go into New Jersey, like let's say you're flying into New York and then you're going into New Jersey to see clients, well, then you're gonna probably rent a car or you're gonna take an Uber. And I look at that and say, yeah, I think that this business, if you look at our Avis bond, I think that Avis will continue to pay us, the 6%, 7% coupon. If we look at, I'm going to pull it up here just to show you all of our bonds. Show you Avis here. If we looked at Avis, here they are, and we, again, don't want too much in any one bond. The price is going to fluctuate, right? So I paid $99.54 for that bond. It's at 96. It's gone down in value. I don't care. As long we're going to get our $100 back in Avis budget when the bond matures in April of 2023. We're going to get our $100 back as long as they don't go bankrupt. So that's what keeps me up at night, is making sure that we don't have too many bankruptcies. And if they don't go bankrupt, we're going to make a 6.3% return. Now, I could get a call from a financial advisor in St. Louis that says, hey, I'm nervous, liquidate $6 million of my client's positions. Now I have to sell Avis budget. And you'll see the bond go down. You'll see that because I'm selling it, the bond might go down to 96. And you and I might get nervous that the bond's down. But who cares? You and I own the bond outright. We own Avis directly in our portfolio. Everybody in a mutual fund that I'm selling, our mutual fund, is going to get hurt. I can't control the interest rate risk inside of that, which is why none of our private clients own our mutual fund. We own, painstakingly, we take each of the bonds and put them into your and my portfolio. And by the way, all of our 401k at Altrius, all of our associates own the same stocks and bonds that you own also. So B&G Foods, which is also right here in Parsippany, they make Green Giant frozen foods and the popcorn that my kids eat. That's not real popcorn. It's like the junky popcorn. And B&G Foods can go up and down in value, but they're going to pay us a nice 4.8% return. And I don't have to be right all the time. If I made 100% correct moves, then you and I would make a 9% return for our bond portfolio. Well, I know I'm not going to make you a 9% return for our bond portfolio. I might make you 9. I don't think so. I think we're going to make more like 6%, like we've done historically. And we're going to have some defaults along the way. And people yell at me like, why did you buy Windstream? You can see how stressed Windstream is. Nobody's using telephones anymore. And I'll say, well, people are still using telephones. Some people still have landlines, and I think the company might make it, but they might not. We might, only get 30 cents on the dollar. If they go through bankruptcy, we might get zero, like we got like we're probably going to wind up with Toys R Us, just a little bit. So that's what I'm doing on the bond side of our portfolios, is just trying to find companies like Scott's Miracle-Gro, and say, okay, hey, we're going to own Scott's. We're going to make a 5.5% rate of return as long as you and I keep throwing that stuff out in our yard to keep our grass green. And again, even if I'm wrong, it's only 0.5% of our portfolio. We're not buying the farm with any one issue. Anything else?
Hey, Jim, if the House will change hands next Tuesday, what effect is that going to have on the markets?
Yeah, it's a good question. So I think that's the most likely case. Like if I was a betting man, and I love politics. To me, it's fun, right? I've been in these monthly meetings with Republican senators, and I think the Senate's probably going to pick up a seat or two and hold in Republican hands. It looks like the odds are probably 60% that Democrats take control of the House. Gridlock is fine for the economy. I always say, what impact is this going to have on how much Tide is sold in China? And the answer, if there's a Democratic Congress, the answer is probably very little impact at all. I mean, it's actually, the market tends to do best when we have divided a government. So wouldn't be so concerned about that. Now there could be more disruptions with if we, this Congress is so divisive in the government right now that we could have impeachment proceedings, which could certainly cause a lot of instability. It's one of the things. Mikey Sherrill is actually running up here in New Jersey. She's a Naval Academy helicopter pilot, and the Democrats have figured out that, hey, it's really smart if we run females, and it's really, really smart if we run females who are in the military against the old white guys who are incumbent Republicans, and they're starting to pick them off. And I told Mikey, who I like, and I said, Mikey, the last thing we need right now, if you win, is impeachment proceedings. And she's like, oh yeah, sure. And now, again, once Nancy Pelosi is the head of the House, is that going to change? And most of the Democrats fall in line. I think it'll cause a lot of noise. We could certainly have a sell-off of the market in the short term. But longer term, I think people realize if the House is Democratic and the Senate is Republican and we have a Republican president, really nothing's going to get done other than we're still going to spend a lot of money regardless. And the tax law is in effect. The regulations are still going to be quite low right now. The Fed's probably going to keep raising rates. So I don't see it really having too much of an impact on companies because the tax law is the tax law, and that's not going to change. And that was highly productive and highly just terrific for the economy to set expectations and give some certainty to companies. That is a real positive. Now the tariffs are kind of negating some of the benefit of deregulation and the tax benefits that we have. So I don't think that's something Trump wants to mess up. I think it's more bluster, and I think eventually he'll come to some conclusion and kind of declare victory on the tariff issue. But it could get strung out a lot longer with the Chinese. He's certainly playing hardball with them. So we'll have to see. So my guess is, regardless of what happens next week, we're going to be fine. Again, as a patriot, I have my own positions on it, but as a capitalist and as an investor, I try to tune out, kind of like that blog I sent out about politics. Don't worry about it. And my friend Todd, Senator Young, I actually said to him in my blog, I said, listen, whether Todd or not is elected, and he was running against Evan Bayh, and Evan Bayh of Indiana is like Jesus, right? I mean, he was almost Obama's vice presidential pick instead of Biden. And when Todd was running against Bayh, I said, Todd, I'll keep supporting your campaign, but man, I just didn't think he was going to win. But he beat Evan Bayh. But I said in my blog, I said, regardless of whether Todd wins or not, this is not going to have any impact on how much, Pepsi is consumed in India. And Todd texted me back and said, "Hey, what do you mean I'm not going to have an impact?" You know, joking, realizing he's really not. No, he's a great American and a good guy. And it's nice to know politicians. There are a few good ones out there. But really, had he lost or had I met the Republican Braun, who's running in Indiana against Donnelly. Donnelly's senator right now. I want to see Braun win in Indiana, but if Donnelly wins, it's going to be okay. Our portfolios are not going to plummet just because Donnelly won the Senate seat in Indiana, in my opinion.
Thanks, Jim.
Yeah, it's a good question.
Just keep up the good work and don't worry about anything.
Well, you pay me to worry about everything, so I'm trying.
Don't worry about anything.
I'm trying.
Just keep on making money, and then we'll all be going to be happy.
Exactly.
Hey, good. Hey, that was I learned a little bit more than I knew before. You're doing a good job, Tim. Yeah.
Well, I'm gonna get my book out to you, so hopefully the book will be helpful too. Because I put a lot of work into that thing, so I'll be sending that out as soon as it's published. It's in publishing now, so I'll get it to you definitely before Christmas, and hopefully I can get them before Thanksgiving.
Yeah, I'm surprised Louis didn't join us. I guess he's busy tonight.
Yeah, he got a better offer, so
Yeah, probably. He's watching football or something.
Yeah, exactly.
All right, Jim.
All right.
Hey,
Well,
listen, you guys have a good show. Let's say you guys keep up the good work, and hey, we'll see you soon. I hope. All right.
Yep, we'll see you very soon. Thank you very much for tuning in tonight, and
all right.
I appreciate it.
Take care.
If anybody has any other questions, just shoot me an email, and I'll get right back to you. Thanks, John. Appreciate it.
All right.
Everyone.
Take care. Good night now.
Night.